Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We've now had 10 interest rate rises in a row, and many homeowners are dealing with the reality of mortgage stress. And that's even before hundreds of thousands of households roll off fixed rate mortgages onto higher variable rate loans. I wanted to find out the options for mortgage holders in this rising rate environment. Graeme Holm is the CEO of Infinity Group, one of the country's most awarded mortgage brokers. Graeme, welcome to Fear and Greed.
Thanks, Sean. It's a pleasure.
How tough is it out there for people with a home loan, and particularly for those rolling off those fixed rate loans?
This is going to be a bit of a two-edged sword, and some people will like the answer, some people dislike the answer, but we've got just under $10 trillion of residential real estate in Australia, but we're only sitting at a couple of $1 trillion, just over $2 trillion in debt. So the truth therein lies that about 80% of our residential property has no debt in Australia. That being said, the average everyday family is absolutely struggling, Sean.
Okay, so we talk about mortgage stress. How do you define it, and how do we measure it today against 12 months ago before the rate cycle began?
Yeah, so mortgage stress, obviously, I guess defining it, when a household's really struggling to make payments, make their bills, typically in the industry we'd say that's when more than 30% of their income is actually going towards loan repayments. Now, not only mortgage stress, we're having that in rental stress right now. We're seeing that across the board for most families. So it's pretty scary. Yeah,
it's really scary. If I'm in that situation, I mean, what do you recommend?
Yeah, look, Sean, people hate the B word, and I don't want to throw it out, but the old budget. You know, people think budget's living in scarcity, but it's actually quite contrarian, to be honest. If we actually sit down and say, well, X amount's going to food and, groceries and alcohol, etc., work out our discretionary spending and actually put a plan in place. I mean, we don't jump in the car to drive to work without a route. We know which way we're going and how long it's going to take. So it's really critical that people actually sit down, look at what they're spending, where it's going, and actually put a plan in place.
Okay. I mean, I've done it at different times in my life when I've found myself under financial stress, be it mortgage stress or others. I couldn't agree more, because once you actually sit down and think about where you're spending your money, inevitably you find things that you can cut, and it also makes you very cognizant of where you can hold back energy prices, those sorts of things.
Correct. Yeah, look, we can cut costs everywhere. It's not easy for everyone to say, oh, look, I'm just going to go and earn more money. But the number one strategy that we tend to find is successful all the time for any family is if they actually look at the correct loan product, Sean. So if they can actually consider how they earn their income, the frequency of the income, and look at products that allow them to actually overpay or direct all or most of their income to the debt. And that can apply to car loans, home loans, credit cards, etc. Because it's obviously, when people understand that interest is being calculated daily, the more they can put at the debt, the more interest they'll save, i.e. the less they'll pay, and the larger the principal reduction. So I suggest to people that they don't actually look for what appears to be the cheapest loan. They should look for the best loan.
Okay. So what about the market at the moment? As a mortgage broker, you would be across many offerings from lenders. We talk about people rolling off fixed rate loans, and we certainly subscribe to the view that, anyone that's rolling off a fixed rate loan should shop around. It's their right. And even if they don't change, they may actually get a better deal with their current lender. The flip side, though, with rates rising, and it seems credit standards perhaps tightening, particularly after what's been going on in the US in the last week or so, is it as easy as just finding another loan, or are the banks more demanding?
Yeah, this is the thing, Sean. It's become a bit of a chicken egg scenario. It's actually pretty bloody hard for people. With the 3% servicing buffer at the moment, you've got, most lenders sitting in the 5s, some into the 6%, but a bank or a broker has to pretend that you're paying an additional 3% buffer on that. And that's what has kept the Australian housing market pretty resilient. We've got tight credit policies. But if you're coming off a low fixed rate now of 1.99 or 2.29 and entering 5.99, and they should shop around, Sean, but it's pretty hard when the bank says, oh, we're not going to give you a refinance because when we apply the 3% buffer, you couldn't afford the debt you already have. We've had to go and build a product in the last probably 3 or 4 weeks for this with a couple of mortgage managers and wholesale lenders that say, no, I understand that, but if you've shown me that you've consistently not missed a repayment on your home loan for 6 to 12 months and you're still employed, I don't think I should apply that buffer if I'm only giving you the exact amount of debt you currently have. So in other words, you're going to see some lenders come out in this space that say, no, we understand you can meet your liabilities. You've not missed a repayment. We do want to give you a better deal and help you out. Whereas the mainstream lenders are really crippled by that APRA 3% buffer.
Stay with me, Graeme. We'll be back in a minute. My guest this morning is Infinity Chief Executive Officer, Graeme Holm. Until you said that, I haven't thought about this. So if I come off I'm fortunate enough to be on a fixed rate loan of 2.29%, I think. I come off, I'm actually not, I've got another 12 months, Graeme. I'm boasting here on the show. But what if I come off and I go to a 5 or 6% loan plus 3%? If I can't afford that as per prudential requirements, what does the bank do? What does a lender do?
So this is the scary thing. I get a bit wary of fixed rate loans because of the hidden fees and charges. And if most people with a low fixed rate loan look at the comparison rate, they're going to roll you out into a very basic, no frills, high interest rate standard variable product, Sean. And if you don't meet those lending regulations, you're not going to be able to move. You will have zero choice.
Yeah.
And it's not so much the cliff for people coming off fixed rate that everyone should be worried about. It's when they come off fixed, not having the best deal with their current lender and not being in a position to negotiate as a consumer or shop around.
That's quite scary.
Very scary.
Are lenders doing enough in this area? I mean, we hear plenty from lenders, and admittedly, it's often the big banks saying they're looking after customers. Are they doing enough?
I'll bite my tongue, but look, I would say no. I mean, look, a rising interest rate environment is amazing for banking institutions, and let's be honest, they're making billions in profits, not half or not one, they're making billions. So, I don't believe that they are doing enough. There are some non-major four-bank lenders and lending institutions that are coming out and having a crack. And there are those fringe players where the money's coming from the same location, so it's not any riskier, but then they don't have branches, if that makes sense. So I definitely encourage your listeners to shop around, think with their feet. But it is scary that the banks are just going to assume that you're going to roll out, oh, sorry, when I apply this 3% buffer, nope, you're stuck where you are. I had one last week that if they went to that new lender, they would have come out from 2.19. They should have come out to 5.49, and the banks rolled them out at 6.09 and said, oh, well, that's your new product now because you're on a fixed rate.
Really?
Mm-hmm.
And they're allowed to do that?
Well, that's the problem with the fixed rate. If you're taking that initial fixed rate term, the product that you roll out to is all not typically very nice at all. It's usually the standard product. You have to renegotiate with your lenders. You may pay some package fees. You may pay some variation fees. There's always the devil in the detail when you're looking at a fixed rate loan.
Okay. And for many people, it's not like they can negotiate otherwise, because with that 3% buffer, they're suddenly looking at a 9% rate, which is very difficult for some people to afford.
Correct. So it's pretty scary times. I mean, look, admittedly, money isn't as dear as it was, 2010, 11 before rates started dropping. But applying that serviceability buffer is really hurting everyday families. I mean, if you were listening to Philip Lowe when he promised that rates wouldn't increase until 2024.
I was.
Yeah, and you were any age, not a young, but a young first home buyer, any age, and you went out and borrowed 90% or 95% to get your first home. And Aussies, as we know, will do anything to get their first home. And all of a sudden, rates have moved every month on month, nearly for the last year. You'd have to be pretty disappointed, is the polite way to put it.
I must say, I'm a big fan of mortgage brokers, and I have never not used a mortgage broker in probably the last 20 years, I think, because the moral for me is that you can go to your mortgage broker and they have to be independent enough to do the right thing by you. And I think the reason I like mortgage brokers is that they are a third-party voice. It's just not me and the lender.
Yeah, people do get stuck, and I've got a few sayings, but I won't rattle them off to pick on any brands. But typically we end up with school banking as a kid, and we end up staying with that bank for the better part of our life. So I think it's important that people do subscribe to choice and they vote with their feet. But there's lenders out there, or there's policies around lenders and income styles that we just aren't aware of as a consumer. So I definitely suggest people shop around and talk to a really good experienced broker.
Graeme, thank you for talking to Fear and Greed.
Pleasure. Thank you.
That was Graeme Holm, CEO of Infinity Group. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.